30 years, and you started when you're 12?
Yeah, exactly. 11 actually, just hit 41 again.
Yeah,
So,
yeah. I know. I just, it is so difficult to kind of try to figure out what's what and what's up with all the whole mortgage thing, because you just, if you're not on the inside doing it every day, you just don't know it. And I've written down some questions and stuff, and I actually talked to you beforehand and stuff, just some stuff that kind of themes you hear a lot that people don't know about, that they're, that you hear 20 times over, you and your team hear it all the time. So for example, here in the local market, like what's the status right now?
Yeah, it's a good question. And what's funny, before I even respond, so I'll admit some of these things are a little bit opinionated, right? But the other thing is everybody's got somebody that they know that's an expert. Right. And it's so funny when I get asked this question, because we oftentimes tell people, yes, there are cycles in real estate and there are cycles in economics, and we really try to be a student of history in that and pay attention to that, because you can count on certain things to occur again. But Newton's law of physics is not an economic law. So just because our prices have went up around here does not mean that there's a pending doom, right? So what we're seeing right now, and why we're actually in a pretty good spot, is I will compliment many of the big builders out there learned a lot from 2008, 9, 10, 11, right? They don't want to be stuck in a spot where, like as we are today, what is it, the 7th of September, I believe, and rates are in the mid sevens. Now, people hear that and they're going to say, well, I heard this, I heard that. Keep in mind, all interest rates can come or go with or without points, but we're typically right now in the mid sevens. And so there are less people that are interested in buying. However, there are people that are still moving here to Idaho, loving Idaho, want to be a part of what Idaho brings, hopefully not wanting to come in and change Idaho, and they're still consuming this product at a rate where we have a supply at about 60 days. And supply and demand can drive real estate a ton. And so as long as we've got an imbalance of supply, and by the way, I should mention, now we're talking outside the Treasure Valley. We have a massive undersupply nationally. So what does that mean? Even when rates go up, we still see that consistent consumption, and you don't see values going down because the builders are actually able to control that by not introducing too much product to market at one time. And here's the other cool thing. We're still seeing appreciation. Predicted for Idaho as of right now is still over 5% for 2023. Wow. Now, we saw a pretty good lull in 2022, but if you take out the chaotic spikes of 2021, where we went super crazy, example, one subdivision homes were like 375. They would start getting bid up to 425, and at the peak, I believe, like this one particular sub in Middleton, it was about August of 2021, 375 house, there's like 3 in the subdivision available, went for 450. Wow. So then we get back to normal in 2023, and the prices in that subdivision go back to 380, and people are like, see, I told you that's a bubble, that's a crash. It's like, no, you basically just saw a 5%, then you saw a 25, then a negative 20, but we're still up year over year by over 5%. That's healthy growth. That means if you own a $500,000 house, you can expect to see about $25,000 in equity every single year. We're still pretty healthy here. Supply and demand is helping that. The big next question is what happens when interest rates do round that corner and start to come down, and then a bunch more people enter into that market? What do you think happens when the limited supply becomes even more limited?
Right. I didn't know when I bought the home I'm in right now. I didn't know it, but I bought it like in right at the beginning of 2010. So I bought it at the height. And it's worth 2.5 times more now. There's
a funny thing about 2007 through 2012. Anytime you discuss real estate, people want to go to that specific time, right? Because that's severe, it's drastic, it's dramatic. It's like we talk about the news media, they want to report drama. And like you said, even people that bought then, and then later on people said like, oh, you're screwed, you bought at the height of the market. Well, you bought at the height of that peak. Yeah. And now we've had many new peaks since then. It's like people that say, oh, well, I lost my retirement in the market. No, the market dipped, you panicked and sold. Right. And had you held, you would have actually had more money now, quite a bit more money than you had when it dipped. So the common theme in real estate is you probably already need a place to live. Rents are not a fixed percentage. They're 100% interest, and you can almost guarantee in most cases they're always going to go up. Yeah. Cool, based on projected rents, your rent will be over $2,000 within 5 years. Your mortgage payment will still be $2,000. Projected in 5 years, you'll have $50,000 in equity. Projected in rents, you'll have zero equity. So you can stay renting, and maybe, you know, for anybody out there watching, maybe you're the one person that's got the sweet deal on rent that nobody else has. But most other people are about a 5-year curve where their rents will overtake what their mortgage payment will be, and then they'll spend the next 25 years paying more than their payment would have been and having no equity to show for it.
Yeah, rent again, I grew up here. Rent is out of control. I Google the average rent in Nampa where I live, and it's more than my mortgage.
Exactly.
Yeah, so it's like crazy. So now with the big question of the day, rates. When are the rates going to go down? That's the big, you know, everyone's like, you know, when are the rates going to go down? Let's hold on. Let's not buy because it's going to go down tomorrow or the next week. And we've already talked about your houses are going to go up, and you know you got to be careful waiting around forever. But
yeah.
what? Because you're in the know, kind of, and some of no one knows all of it, but what are they guessing when the rates are going to start ticking down?
Yeah. As you and I sit here today, February 7th, the Fed will speak again on the 20th of September. They will discuss whether or not they're going to do another rate increase. I'm not going to do a Fed lesson, but the federal funds rate is the rate that the government lends out money on short-term interest, like home equity lines of credits and credit cards and auto loans. It is not mortgage rates, but it definitely has an effect because as they continue to raise those things up in an effort to fight inflation, it causes the cost of everything to go up. And they're actually trying to slow down spending. To answer your question, most of the factors out there show that anytime soon, air quotes, rates should start coming down. We do seem to have some inflation numbers that have dropped, but they are stubbornly above this level. The belief is that in the next 3 to 4 quarters, possibly by the second quarter of 2024, that the rates start to come down. And they're actually suggesting that by the end of 2024, the Fed will actually have to start doing rate cuts. If anybody's listening, that should make you laugh because they're still talking about raising them up. Yeah. Just the perception, if they said, hey, we're going to stop, instantly mortgage rates would get better. Yeah. Because these rate increases are the enemy of a lower interest rate because of the inflationary factor, right? So we think that'll happen soon. Here's the key. People still need houses and they still need a place to live. So the message when people say, where's the interest rate and where I should buy is, can we create a situation where it's affordable for you, both now and in the future, in comparison with where you're at now? And like going back to that rent thing, you can't just look at it like a moment in time. Because I can tell you story after story over the last decade of people that said no. I'm saying no. I can tell you stories of when I was quoting $1,200 a month payments on $250,000 houses, and people were saying no because their rent was $800. And I know some of those same people now, and their rent's $1,800, and they would have $250,000 worth of equity and a housing payment that's now $600 cheaper than their rent, but they didn't want to strike then because it was $400 higher. So crazy stuff there. We do think we'll see stuff start to subside, but here's the big question. If everybody's standing on the sideline and we have very limited inventory, what do you think is going to happen the minute that you hear the media say rates are going down?
Yeah.
Well, now you just have 3 times the amount of people chasing after your very limited supply, and while you waited for a lower rate, you just paid $20,000, $30,000, $40,000 more for that house. And here's an interesting analogy. If today the rate's 7%, and the house is at $400,000, and a year from now the house is at $500,000 and the rate's 5%, take a guess which one has a higher payment and less equity, the person that waited, right? Most of the time waiting on a cheaper rate puts you in jeopardy of paying a higher price for that product.
Yeah, I've heard something from a younger person. I didn't know the term, but they said that rather than wait around, they got their parents to help fund it, and then they house hacked it. They had 2 roommates move in.
It's what's interesting. What I've seen some young people where I've done the loan app and I've told them what the payment would be, or I've told them how much money they had to have into the deal, or how much money that they needed to have into the deal to make the payment work for them. Because we should differentiate. There's still a lot of very low down payment products out there. It's amazing that these people automatically assume that their older family members, parents and grandparents won't help them. But when they approach them and actually say, hey, I'm approaching this level of maturity where I'm considering becoming a homeowner, some, not all, of their parents and grandparents are so delighted to see them take that step. They're like falling over themselves to help them.
Now you mentioned that, it made me think about my first house. Actually, my grandma stepped up and gave me some money to help for the down payment. So.
Exactly.
Hey, what about when it comes to nowadays, speaking of my grandma giving me some money, down payments? A lot of people always think you got to have some huge 20% down payments. What are there any other products or how I mean, I'm sure that keeps a lot of people on the sidelines. So
again, that's a very open question. I'll try to keep it brief. So first, the funny thing is there are still people out there that'll say, I got to have 20% down. I'm like, no, you don't. We actually have programs with 0 down and 0.5% down. Now, I have to pause because there's another group of people that would say mortgage insurance is a scam. So mortgage insurance is for someone that doesn't have 20% down. Right. 20% down is the threshold at which if you buy a house and you live there and you stop making the payment and they have to kick you out and evict you and foreclose, they need to have a 20% buffer to not lose their rear end, right? So if you only have 5%, they're basically getting an insurance policy for the other 15%, which, by the way, if your credit's really good, is actually a real reasonable amount. Sometimes you're talking about for $100,000, you're paying, $100 a month. Right. In the meantime, you still own the house, you're still accumulating the equity, and hopefully down the road, we're in a position with rates like we already talked about to be able to refinance out, and at that point, possibly eliminate the mortgage insurance as well. So for the people who think mortgage insurance is a scam, I can tell them the countless stories about people that were able to buy houses when they wouldn't normally be able to buy a house. And then they got to live there and accumulate a lot of equity, which they eventually refinanced and got out of the mortgage insurance, or sold the property and accumulated a lot of wealth from that.
That's really good, because I totally didn't. Here I am, own 2 homes, and I went through that exact same thing, and I didn't understand that. That I didn't have the full 20. Obviously, I didn't have the full 20% to put down. It got to the point where I refinanced, and then I didn't have to have. It was whatever the ratio was. I didn't have to have the.
About 20% usually. Yeah. So to answer your question, there's programs as little. Generally speaking, I'll give a plug. Idaho Housing and Finance.
Yeah, that's my first house.
One of the best housing agencies on the entire West Coast. They have some of the best down payment assistance programs. So sometimes people will hear first-time home buyer. They think it's some sort of a coupon that's going to get them a better deal. First-time home buyer doesn't necessarily mean the cheapest rate, but oftentimes it means the ability to put a much lesser amount down. So they have several programs that are 0.5% down. So quick analogy, $400,000 house, you can get in for $2,000. Wow. So if you think about just like if you go rent an apartment right now, say the apartment's $1,500 a month, but you don't need $1,500, right? You need $1,500 first, probably last, in some sort of a security deposit. So let's just say that's $3,500 or $4,000. There are a multitude of examples I can give you where you could buy a home in that range. Now the rent would probably right now be a little cheaper, remember, but with less money out of pocket, you actually become a homeowner rather than a renter.
See,
right?
that's why I brought you on. I think of all these different options, and that's a perfect one right there. Is that rent is just, again, it's out of control here. Is how expensive it is, and somebody will tell how much their rent is, and it's $1,500, $2,000, and I'm going, you got to be kidding me. It's that much money. And then exactly what you said, that you have all that money you got to come up with to rent. Why wouldn't you take that money if you could and go to someone like you and have you make it work so you can buy a house rather than rent?
Right.
You have people that get like a whole bunch of debt. Credit card debt's one I always think about and stuff. Is, do I refi, HELOC? I mean, what are the options?
Yeah, and this is a great question, and let me tell you why. Okay. We just hit the highest point of national debt when it comes to the U.S. citizens, the amount of money that they owe on a credit card in the history of mankind.
Wow.
Right? Right now, United States citizens owe more money to credit card debt than ever.
Holy smokes.
Now, here's the good news. We also have more equity in our homes than ever. Right? Now, here's the problem. But I bought my house in 2021 and Devin got me $299. I don't want to refi. So there's a thing, and first off, we'll talk about getting a HELOC, a home equity line of credit, which is traditionally a second mortgage, versus refinancing the existing one. Okay. So obviously, the logical answer would be, no, I'm not touching that first mortgage because it's at, Devin's saying he can get me 7% right now, and I'm at 299. Yeah. But the problem is, and we'll talk about HELOCs, if your outgo, or if you've got 50, 60, 70, 80, 100, yes, I see it every day, of credit card debt. So here's a quick analogy. You have a $200,000 mortgage at 3%. You now owe $100,000 in consumer debt at 30%. Would you like me to do that blended math? Because that's 2 parts 3 and 1 part 30, which is 36. You divide that by 3, your interest rate's 12% on your outgo.
Wow.
And you're afraid to refi at 7 to get rid of that debt. I know I went real quick on that math, but that's happening every day out there. But if I can save you $1,000 a month by refinancing and raising your rate, but lowering your monthly outgo, and you can now afford to pay your bills, it's pretty tough to criticize you to say you made the wrong decision to do that and utilize some of the equity that wasn't really your money. It's just equity you gained by being smart and owning a home and living there, and eliminating that debt that you put yourself in. So here's the scoop. HELOCs, cheaper to get. You go get a home equity line of credit from a bank. Some banks will give them to you for nothing, but in my experience, I see anywhere between $500 and $1,000 all in. That's cheaper than the best. That's 4 times cheaper than the best lender in town can get on fees. Because when you do a full refinance, you have to pay all the title fees and costs and everything. So even if we're giving you the good guy deal, the HELOC is cheaper. But a HELOC is typically, in most cases, a variable rate. Right. So that means that rate goes up and down. And right now they're typically in the 9s. You hear me say typical because I see stuff all over the board. I saw a HELOC the other day for 11%. The scary part about a lot of HELOCs, a HELOC can be a 30-year amortization, so the payment's very cheap, it's stretched out, and they're oftentimes interest only in the beginning for a period of 5 or 10 years. So $100,000 even at 9% is only going to be about $9,000 a year in interest, which is only like $750 a month. So you borrow $100,000, it's only $750 a month. You get rid of all your debt, that $100,000 credit card, you were probably spending $3,000 in minimum payments on those, and now it gets really comfortable to only pay that $750. Well, the problem is that goes on, and eventually when that interest only period is over, it will become fully amortized over a shorter period of time, and that payment can double or triple up. When people say, Devin, HELOC versus refi, first thing I say is, okay, well, if you're a gambler, you can get the HELOC and kind of hang in there and make sure that you don't keep it for a long period of time. You really want to have an exit strategy. Like, I plan on selling the home, or I plan on selling some other asset and having the money to pay off the HELOC. You don't want to get caught with a HELOC on the back of your mortgage for a long period of time. So there's a little bit of a risk tolerance and a threshold there. So it's an interesting argument, and the answer is there's no right answer for any one person. Find someone that you trust in the industry and actually ask them, I don't just want your opinion, I want you to break down the numbers for me, and let's talk about short and long-term options and see what's best for me.
Yeah, the HELOC thing, it's a good example. Is I didn't understand them. I actually had a banker explain them to me, and I tell you, they didn't explain it like you did. It's it's a good deal, it's a good deal. And then I've talked to some other people that said they got totally in trouble because they just paid the interest only,
minimum payment,
and all of a sudden they just weren't paying attention, and then the rates go up, and all of a sudden they got this. So it's like anything, you got to be very dedicated and know what you're getting into. Big question of the day is you have like banks, credit unions, and then American Pacific Mortgage. You guys. So what's the
so we're difference? A retail mortgage banker, and I'll quickly hit on that. So this is the part where we've done this whole talk, and if somebody's going to not like me, they're going to not like me right now, but that's okay. Okay, so just exactly what you just said. And I'm going to preface this with there's great people that works at banks. Yeah. There's great people that work at credit unions, and there's great people that work at broker shops, right? Most retail mortgage bankers, especially those like me that are old dinosaurs that are still around, we consider ourselves relational people that look for customers for life, that have the kind of customers like you might have with a trusted financial planner, where they can pick up the phone and call me on a Friday night, on a Sunday afternoon, on a Wednesday, and if I don't answer, I'm going to get back with you and say, I have this question and it specifically pertains to me. Give me the answer that pertains to me. A lot of times people we've got I'll just say the Stagecoach Bank. Okay, I'm going to leave it at that. Right. Hey, my parents bank there, I bank there. That must logically be the best place to go get a loan, a mortgage specifically, right? Okay, so here's a couple things. The person writing your mortgage is not required to have any annual continuing education. Me personally, I've got my 8 hours of federal and another 10 hours between all the states I'm licensed in. So every year I'm forced to pass all these tests and all that and get that again, When you work under the bank, because of their lobbying efforts, banks and credit unions, their people are not required to hold any kind of a license. They're basically just attached to the bank. That person may have been a teller last month and done a really good job and just recently got promoted. They may have been doing credit cards. They may have been doing car loans. And they typically will have a floating loan officer that works over many, many branches. So there's no relationship, there's no loyalty. People that work at a bank, because of everything we just discussed, they walk in every day and someone sprinkles food in the goldfish bowl. Right. It's expected. They sit at the desk and the stuff drops on the table. If I walk in, my desk doesn't have anything on it in the morning, and I am 100% solely responsible for putting something on that desk. So what does that mean? I have to be sharper, better, smarter, do a better job, have better follow-up, have better customer service, get back to people quicker. And the person I'm competing at the bank, oftentimes the only thing that they may have is a lower rate or a perception of a lower rate that's not even true. But it's just the perception that if I'm going to my bank, it must be the best place to go. And that's oftentimes the only thing that the bank or the credit union has to hang their hat on. And so what you'll oftentimes see is we get a phone call in the midst of a transaction. Again, I say if something goes wrong, because it doesn't always go wrong. Right. And it's like, hey, we're 2 weeks away from closing, and this just came up. And it's sometimes really hard for me after doing this for so long, because I say that's a question that should have been asked day one. Wow. Like, I don't even know how to explain how we got to where we're at this point. In some cases, there may be a little tiny bit of a price difference, but I'll tell you, we have witnessed people lose their dream home because the other agent put it back on the market when the lender couldn't perform over a $500 or $1,000 difference in fee. And I oftentimes say you have to be really careful when you're doing one of the largest financial transactions out there. If you're analytical, you might argue, well, then that's why the numbers are that important. But the performance level is also as important or more important, and that relationship.
Yeah, that's one thing I like about you, and other people like you in the mortgage industry, is that it is really a relationship. And I know there's a couple of stories of customers that reached out to you, and you took over a year of working with them. Yeah. One of my favorite is the one was, I think it was a military person, that you gave this person a plan of how, because at the time their credit was wrecked and everything's wrecked, and you gave them a plan and said, like, here's the deal. If you follow my plan, I can get you in a house, but you cannot deviate.
Exactly.
How long did it take him to come back?
Well, that particular guy literally went silent for a year. It was a veteran. He was low 500 credit scores. He'd made a lot of mistakes in his youth. Yeah. And so we just broke it down, and basically I can compare it to like a financial planner writing you up a workout or somebody writing you up a diet. And I said, and you said one of my favorite sayings is, somebody will say, I applied with the bank and they said no. Yeah. Well, they shouldn't have no, they should have said when. Yeah. The answer is not no, it's when. Because if it's not now, it's where are we at and what is it going to take to get us where we need to be. It's not credit's not rocket science.
After like 30 years, you kind of got this down.
Yeah, yeah.
No, that's great. That's great. I appreciate it. So this is another episode of Treasure Valley NIA QuickTips, and what it is I am a franchise owner of Network in Action. It's a franchise. It's a once a month professional referral group, and they're out of Houston, Texas. And about 2 years ago, a lot of my members, like you, I wanted to get, there's a lot of confusion and stuff in the industry, so bring local experts here in the Treasure Valley, Idaho, and get them on and share the information to the listeners. So that's really how this came to be. Yeah. And introduce yourself real quick while we end the.
Yeah. So Devin Fahrner, regional manager, janitor, loan officer, caretaker. Yeah. We do it all here, but in all seriousness, we write a lot of mortgages from anything from first-time home buyers to reverse mortgages, dabble in a little bit of construction lending and stuff like that. And we're just basically looking to help people, educate them, not just, again, be an order taker, right, but get them either now financially fit for down the road, or get somebody in today and close a loan for them in 2 weeks if suddenly the time is right, and just basically help them build generational wealth through home ownership.
Awesome. Well, this is Scott Marker. This is another episode of Treasure Valley NIA QuickTips. And so till next time, thanks, folks.